Two popular dividend-focused ETFs are SPHD, the Invesco S&P 500 High Dividend Low Volatility ETF, and SCHD, the Schwab U.S. Dividend Equity ETF. Let's compare them. First, note that I don't chase dividends, but I recognize that many investors use dividends to supplement their current income, particularly in retirement. Others just irrationally prefer dividend-paying stocks. I even designed a dividend-focused portfolio for income investors. In any case, these two funds are very popular and take a pretty different approach. Here we'll review these dividend ETFs and explore the differences between them. SPHD launched in 2012. It is the Invesco S&P 500 High Dividend Low Volatility ETF. As the name suggests, SPHD is comprised of a basket of high-yield stocks from the S&P 500 that exhibit lower than average volatility. Appropriately, SPHD tracks the S&P 500 Low Volatility High Dividend Index. This index takes the 75 highest yielding stocks from the S&P 500 index and then picks the 50 lowest volatility stocks from that basket, and then weights them from greatest to least dividend yield, with sectors capped at 25%. SCHD is the Schwab U.S. Dividend Equity ETF. It launched in 2011. The fund seeks to track the Dow Jones U.S. Dividend 100 Index, which is comprised of 100 stocks with at least 10 consecutive years of dividend payments and a minimum market cap of $500 million. Stocks are then selected for the index by screening for yield, profitability, and cash flow metrics and projected dividend growth. The fund excludes REITs. Individual companies are also capped at 4% and sectors at 25%. Unlike SPHD, SCHD does not care about the volatility of its holdings. As we'd also expect, SPHD's yield is a bit higher than SCHD's by about 0.5%. In terms of factor exposure, SPHD tilts small, i.e. positive loading on size, and also has slightly higher loadings across value, profitability, and investment compared to SCHD. The more stringent selection of SPHD also comes at a much greater cost. Its fee is 0.30% compared to 0.06% for SCHD. Now let's check out the sector breakdown of SPHD and SCHD. Notice how SPHD massively overweights traditionally defensive sectors like consumer staples and utilities, while severely underweighting technology compared to the broader market. This makes sense, as these defensive sectors are notorious for high dividend yields and low volatility, while we can say the opposite about the technology sector. SPHD also drastically overweights REITs at about 11%, while REITs only comprise about 4% of the broader market by weight. SCHD, on the other hand, has basically zero exposure to utilities and REITs. Here's a performance backtest of SPHD and SCHD going back to SPHD's inception in 2012, looking through 2021. SCHD has massively outperformed SPHD over the backtested time period on both a general and risk-adjusted basis, due mainly to its much smaller drawdown and much quicker recovery from the March 2020 crash. A glaring irony here is that despite SPHD selecting lower volatility stocks, its volatility has been greater than SCHD, even though SCHD doesn't really care about the volatility of its holdings. This is because, as I've noted elsewhere in regards to SPLV, while it may seem counterintuitive, a basket of low volatility stocks does not necessarily result in a low volatility basket. In conclusion, if you're solely focused on yield and or prefer to massively overweight consumer staples, REITs, and utilities relative to the broader market, SPHD may be of use. Otherwise, I'd probably take SCHD out of these two. Remember too that SPHD is 5 times the price of SCHD. In any case, in my opinion, neither of these funds is perfectly suitable as a core holding in a well-diversified portfolio. Conveniently, both these funds should be available at any major broker. Do you own either of these dividend ETFs in your portfolio? Let me know in the comments. Thanks for watching. Some of the links below are referral links at no additional cost to you. If you choose to make a purchase or sign up for a service, after clicking through those links, I may receive a small commission. This allows me to continue producing high quality content on this channel and pays for the occasional cup of coffee. I have first-hand experience with every product or service I recommend, and I recommend them because I genuinely believe they are useful.